All right, everybody. You are now being recorded. Again, I appreciate everybody coming to this deal presentation from Candace Major. I'm going to do a quick introduction and then I'm going to turn it over to Martin and his team, and they're going to go ahead and they're going to tell you all about the deal, about themselves, all of the opportunity. So I'm just going to quickly start out by sharing for those of you that haven't really done much on the commercial side of Candace Major. My name is Trevor. I've been a big dog for 6.5 years. And within the Canvas Major community, I am leading and launching a refreshed version. I would say the most important thing we're doing is a lot more education on passive investing. So for those that don't know, I'm a noon coach every Monday. We do special educational property tours. So we just did a development tour last month. We did multifamily up in Dallas area. We have passive investing coaching webinars, passive investing opportunities, which this one is, and then networking events. So for those of you that are in cities, I know I've met a lot of you there, but I always come to cities. I try to do a little hour presentation about commercial real estate before the main networking comes. For those of you that don't know me, I joined Candace Major back in 2018. I'm going to give you my information in a minute here. If you have any questions about Candace Major, any questions about this opportunity, I'm so sorry, pop that up in the wrong screen. I am very happy to have a call with you, talk to you, give you some ideas about passive investing, what you should do, all the different things. So I'm going to put my contact info in the chat. And so I have started as a passive investor. So passive investing is what we're talking about today, where you would invest into somebody else's syndication. And again, I can always spend some time on doing that. And then I've been an active sponsor now on 14 deals, thanks to this one. It's bumped me up to 14, so a total of 34 syndications. This disclaimer here, I'm actually going to read this whole one, and Martin will have one for his group. But this is the Candace Major facilitates and collaborate between members by assisting them to set up presentations for members with investment opportunities and inviting other members to present these sessions. Candace Major does not endorse, vet any of the investment opportunities that are presented by its members and is not responsible for an investment opportunity for a non-performing, not performing as presented. All members are advised to carry out their own due diligence and the investment opportunity prior to making any investment decisions. So a little bit about our opportunity today. I'm just going to give you a really high level. So there's Martin and his wife there in front of their beautiful motor home. Very high level. This is a special presentation. Normally, we try to get to these to you a little bit earlier, but this one, the timing just didn't work out. So I want to explain that currently, this is what's called a 506B opportunity. A 506B opportunity is open to accredited and sophisticated investors, but more importantly, it's open to sophisticated investors. So again, be a sophisticated investor. We can talk about that privately, what that means. But the most important thing for you to realize is this one switches to a 506C July 28th. So we have a very short window. If you wanted to make an investment in this opportunity and you were not an accredited investor, normally I try not to have this tight timeline, but it was just the way that everything fell with this opportunity. So again, you've got to make sure that you understand. So again, a 506B pre-existing relationship that comes through the big dog community. You must be considered a sophisticated investor. If you're not sure, I can help you understand this. There are only 35 spots that are open to non-accredited investors. And again, we normally present these very at the beginning. This one we've got delayed on, so I apologize for that. But again, this is a great opportunity. I can't generally solicit outside of the group. And then when it switches to a 506C, it's only open for accredited investors, which is a net worth of $1 million, excluding your home, or personal income of 200, or a married income of 300. One of the things to note, there is no difference in the opportunity of a 506B or a 506C, only who can invest. So that's a quick introduction. I'm going to go ahead, Martin. You should be able to share your screen, introduce yourself. You can also introduce some of your partners on the call, especially those that are part of the Big Dog community. Um, Awesome.
Fantastic. Does that show right?
It
See the
does.
first? Awesome. Well, thank you. Thank you, Trevor, and thank you to the Canis Major Group. This is a great opportunity to present something we are super excited by. There's four of us that are general partners. The team that's putting this together and going to run this, all four of us are
Come
on the
on,
call.
Gilbert.
As Trevor mentioned, Jenna's here, my wife. We also have Sandeep Mamidi and Amber Lackey. Both of them are here and on the call, available for questions. Um, we'll
Good
get
morning, listener.
we'll get into their experience, but it's they bring a tremendous amount to the table, and we'll kind of walk you through everything. This is a picture of one of the parks. This is a two-park acquisition. They're across the street from each other. This is one park on one side and one on the other. We'll go into a lot of details. Let me start with the dream. Everything starts with the dream. Our dream, Jen and I, and then as Amber and Sandeep have come into this as well, if you've got a dream, you have to chase it because it won't chase you back. And that's certainly true about dreams. As we thought about this with RV parks, we were looking at a number of different things. We'll go into our backgrounds, but we've done corporate stuff, we've run our own businesses, and then we started doing commercial real estate some years ago. And as we looked at it, we were looking for the asset class that both moved the wallet and moved the soul, and we're sitting up in a park in Idaho, in the picture all the way on the right, and ended up meeting the owner of that park, and it opened our eyes. It began the process of saying, hey, who actually owns this, number one, these kind of parks, and is this an asset class we can go after? And as we unpeel the onion there, layer by layer, we found that there is a tremendous opportunity in this asset class within commercial real estate. So that's what we'll talk tonight about. As Trevor mentioned, we've got a disclaimer as well. Uh, we are not, we believe everything in here to be true and accurate as we've understood it through our due diligence, but everyone on the call needs to get their own advice and counsel, financial, tax, legal advice to make sure that everything matches what you need to have in place. Quick overview of the agenda. We'll hit the executive summary and then go into the plans, financials, the actual RV park investments, because I think it's important to understand. We'll pick up questions at the end for whatever time is remaining. So this is the second park that was the little one in the picture. This one's called Twin Lakes, as you can imagine, with the two lakes here, this and this. And then the other park now is across the street. So we'll come in one. Quick overview. This is what, and some of this was on the information Trevor had sent out. This acquisition is for the two parks that you see, Twin Lakes and Scissortail. These are located in Ada, Oklahoma, which sits about 2.5 hours from us in Dallas, uh, about an hour and a half from Oklahoma City, and about an hour and a half or so from Tulsa as well. So kind of in the middle there in southeastern, more or less, Oklahoma. This $3.6 million purchase covers both parks. The IRR, as we've developed the business plan here, is just at 24 and a half. The AAR, the average annual return, is at 33%. We'll break down into greater detail. Cash on cash, 11%, very strong. That's over a 5-year average. It ramps up, and we'll go into the business plan, but the first 2 years are over 7%, and then it ramps very strong because we're expanding the park as we go. 2.65x on the equity multiple, so very strong return there. Most important for any asset class that may be new to folks, making sure it cash flows on day one, that these are profitable properties, that they are making money from the day we take over, that's important to the business plan, that it's not a turnaround plan where a whole bunch of things have to go right in order to start making money. It's making money from day one. And then we're going to expand it. And that's part of what the equity is for. Then we'll go into some others. And the last point is an important part, one that you don't find in a lot of properties, a lot of projects. The CapEx for expansion is paid out. First part is going to be paid by equity, what we're raising here. But the second phase and the third phase of expansion, CapEx is paid out through cash flow. This is one way make sure we preserve the power of the equity that's brought in at the beginning, build the parks through the expansion through cash flow, which gives greater returns to the investors from the beginning. It also makes sure that we are not raising a lot of equity now for expansion plans in year 2 and year 3 on down the road. That's another way that it maximizes your return. High level overview of the parks, the business plan. Oops, wait a minute, flipped over one too many. There we go. Year 1, purchase the parks and then expand them immediately. When they cash flow like this, you want to jump on it, and we'll go into the reasons why we want to move right away. Years 2 and 3, we'll continue the expansion, and then we'll professionalize the operations. Years 4 and 5, we optimize the operations that are ongoing there, reap the rewards. That's for the partners. And then in year 5, we will have prepared to sell the properties and move on from this investment into the future investments. But obviously, LP money goes back to them. So that's the high level, couple phases to it. There's more detail that comes. So that's the same thing you just saw. Now, as we look at the overview on the deal itself, 3.6 million, we've covered that. It's a long RV park. There's kind of two different types, and then some in the, but there's transient ones where you might go for a long weekend, a weekend, a week. Then there's long term at the other end of the spectrum. We'll go into some more details about, but this is very much a long term. Both of these parks are long term. Very important. What are we doing with the money? What's the sources and uses? For the 3.6 million debt, we've got a loan in place. Well, we're finishing the qualification for that, and everything's gone well. 2.52 million on the loan, and outstanding interest rate, we're able to secure 6.75% interest. That's on both a 25-year AM schedule and a 25-year loan. It's in 5 periods of 5 years each, where the interest rate resets. So for the life of this investment, it's set for 6.75 if we exit in 5 years. If we need to move on, if we need to extend it because it's not the right selling opportunity in 5 years, the loan is still in place. So what happens on a lot of projects, rigidity comes in because you don't have the funding in place for the next years. It's already in place with this one. 70% LTV, and then the equity required, we're raising 2 million of this. For that 2 million, the CapEx budget on the first part of the expansion, 277,000. Most of that is on a 20 pad expansion. We'll go into some more details on that. And then there's other dress up things that are happening in the park to make them to bring up the look and feel of the parks. And the third one, sorry, LPGP structure. 70/30 straight structure from the beginning to the end. As Trevor said, no difference for 506Bs or Cs, and also no difference between general partner money that comes in and limited partner. The one difference is limited partners have a 7% preferred return, and this is accumulated over time. So if 1 year returns were a little below 7%, say year 3 was light and it was 5%, that 2% gap that we're on the preferred of 7, that 2% rolls over to the next year. So limited partners get paid their 7% preferred before general partners get anything for that year and or the project as it plays out. So 70/30 split. Fees on this, 2% on the acquisition fee, 4% ongoing asset management, 4% of the gross revenue. Target investment, $100,000, the hold period for 5 years. There is a minimum investment available of 50, anything in between above 100 as well. Important to note, 700,000 general partner equity participation. So 35% of the 2 million is being put in by the partners. There's no greater sign of belief in a project than there's real skin in the game being put in. We started with the idea of having 20 or 25%, but we decided to up it a little bit more, and we're sitting at 700,000 equity participation from the GPs, and that money would be in as LP money. So if you kind of like the structure of the deal, the returns, the things that are going on that you've seen, who's the team behind it, and what's the belief that we can deliver it? My wife and I, Jenna, are the key sponsors, the lead sponsors on this. We've done a number of things. We've had corporate careers. We've gone to the C-suite level. A lot of times people are like, well, if you sat at executive levels, you don't actually know how to run the business, run a business, or get your hands dirty. Exactly the opposite. We jumped out of the corporate careers eventually and then started our own businesses, senior care business, and then also ran oil change, quick lube shops, much like a Take Five, if you're familiar with those. And we've been in the basements of these things when the plumbing doesn't work, filling them out, getting them cleaned out, getting them ready. So we've kind of gone full cycle. On our businesses, we have sold both businesses and CRE deals 8 times. We've gone full cycle on this. The equity multiple in those returns was 3.8x on what's gone complete, which was we've had great success. Not all of them were successful, as you can imagine. We've also had our share of opportunities or what seem to be more hobbies, but we've learned from all of them. In total, 3.8x. We've done graduate school. We've had great backgrounds. We're super excited by this, both in commercial real estate, backgrounds, commercial real estate and corporate. Importantly with us is our Sandeep and Amber as well, who bring a tremendous amount of real estate background, in addition to entrepreneurial experience. Sandeep has run and sold his own software company. Amber has her own company as well, has been running that successfully for a number of years. Combined, they've been running 2,500 plus stores, 125 million assets under management across multiple asset classes. So a tremendous amount of real estate experience, in addition to just business
I'm
experience on
listening
the
to a
team,
pitch that
four of
just
us.
started on that eight.
The next part, we also work with a group of outsiders. These are not they're not on the GP table. They're not limited partners. They're considering investing. So there are some slots that they've got their eye on. They're trying to get us to open up. But these are folks who have run. These are RV park experts. They have owned, operated, built, and currently own a number of parks. The 5 parks currently amongst them. There's 3 gentlemen outside of us. And they also have offered consultation to us. So as we get into it, we may have projects that we request that, but right now they have been a kind of like a board of directors without any fiduciary responsibility, but more an advisory board, providing us insight and experience. And then the last one is the group that we've all come through, Massive Capital, Canis Major running on the other side. Tremendous support that we've gotten. We actually came through Phil and Shanoa Grove and Cree, which then merged in with Massive. So we're all kind of part of the same family. All of them, been tremendous support. Oops. Move over to the next slide. So the business plan and financials. First thing to see is there's significant top line income. We move from the actuals of the current
Looks like Martin, you froze. Did he freeze for others?
or 6,500 per pad. So we built in a little bit of conservatism and fluff in there. But that top line, the 784, is growth from the 20 pads being built day one. Our estimation is it'll take, in the plan, it's not our estimation, but we've built into the plan, it'll take us 12 months to get 10 of them filled up. 12 months to get 10 of the 20 pads filled up. The gentleman who we're buying the park from put 21 pads in and had them filled in 4 months, all 21, and the park is 100% full. So we've been super conservative on the expansion from the first year. The second year expansion to the 868 is adding 10 more pads. So phase 2 is 10 pads. Phase 3 is in year 3, 10 more pads. So that's where you start to see the top line grow. And then we've added in some vacancy. This actually is much higher vacancy than the parks currently are experiencing. So when you start looking then at the next piece as it drops down through the expenses, the NOI starts to explode from the first year of just under 400,000, then picks up out through year 5. The key here to see is this third red circle, CapEx reserves. This is where we're paying for the expansions out of cash flow. When you're generating this kind of cash in a property, in a project, you want to be able to return that to investors. But in this case, our return is through the expansion, because with the expansion, the value to investors grows even greater. So the first year we do the expansion through equity because we've not owned the park. We don't want to build it up. We want to start right away, raise the equity. But then year 2 and year 3 expansions are done out of cash flow that's already captured there. We also show a year four expansion. This is not an expansion of pads. This is adding RV covers, pad covers to the sites in the hot areas of Oklahoma, Texas, etc. These will go for a premium, so you can charge another $100 or $150 a month for these. In terms of rent, people gladly pay that. So we've budgeted for 15 of them coming in at 6,500 a pad cover. High level overview to kind of walk through. These are the same steps that you saw before. We've done the corporate work. We've got Gantt charts. We've got a lot of details behind of when things are going to happen. Purchase and expand and professionalize. So the first expansion, phase one, the 20 pads right away. Second expansion, third expansion, add the covers, optimize it, reap the rewards, and then prepare to sell. And just to bring it back to the kind of ground us in the numbers so you can capture this. RV pads across both parks. And you can see here the picture on the right. This is the Twin Lakes Park, and this is Scissortail. This is just after they had done their expansion. You can see where there's new pads here that are still to be filled, and then some others over on this side. These parks have 93 pads currently. We'll expand on 20 the first year and then 10 more, and that'll be the same. In addition to that, I mentioned very early on the first slide, there's also 18, 19 cabins. There's 3 homes. There's a duplex on one property, a home, a 3-bedroom on the other one, and then there's 12 storage units. All combined, there's 34 of those rentable units, we call them. We're not changing any of those numbers. We're keeping them as we are. We're just growing the RV pads. That leaves the rentable units increasing there, and it's the same kind of structure. One of the questions we've gotten talking with other investors, what happens if we fill up these pads quicker than the 12 months to do 10? What happens if it only takes 6 months? Then we can advance it. The returns advance more quickly, but we can also bring the other 10 pads on in year one or at the very beginning of year two, bring the 10 from year three in. If we see that we fill up this first expansion very quickly, then we can bring the others online because we're paying for them out of the park. There's not a capital call to investors. It's paid for out of the results. So this is a very flexible plan, able to push forward sooner if the results allow that. So my guess is if we were to take a poll, and we won't do this in the interest of time, but most people have probably not been through Ada, Oklahoma. Fascinating little town. It's a bustling little town, and it's one of those little hidden gems. Uh, we've got strong tailwinds, so the market dynamic and the park dynamic for us, we've got strong tailwinds in these parks. Combined, we just had uh, the what do you call it? The evaluator. The valuation was done by the bank. The appraiser was out there. We have the parks currently are at 85 and a half. One of the managers, they just stopped taking calls for the parks, and we're like, well, this is not healthy. But when you're at 100%, they're not answering the calls. So we want to be able to expand the park to be able to fill that. It's in a prime location in Ada. Ada is a bustling little town with a very diverse economy. And this is important. When you're in oil and gas country, Oklahoma and Texas, you want to make sure there's a diversity of employment in the area so that you're not impacted too much by anything. So we've got that going on. There's only 4 parks within 30-mile radius of Ada. The 2 that we're acquiring and 2 others, and they both sit in Ada. There's nothing else within 30 miles. Regional hospital, oil and gas properties are there, projects are there, which bring a lot of people in. And then there's a 3,500 student university as well. And the final point, both other competitors are sitting effectively at $475 a month and no amenities just like ours. We do have 2 lakes on the one, which is quite nice, and 1 lake on the other one, although it's not in the name. Risk analysis and mitigation. So if you like those ideas and the team and the returns that you're seeing in the P&L, the pro forma, what are the risks that we've identified? The first three are things that are kind of out of our control, but we have to deal with. Market demand, we're in a tertiary market. We believe focusing on long-term residents deals with a lot of that because it's not transients. That's what they call transients are the short-term parks. Weather and environmental, we've got a storm shelter in one park. There's another one in the other park. It's not built out, but we're going to build out another storm shelter. Most likely there's a 40-foot container that's already on property. We need to do a little retrofitting to that. But then also in the town, there's storm shelters. So we make sure that we're covered on that and very strong insurance for the investors to make sure that's covered. Economic volatility with the diversity of the employment, the guests that are coming to the park. We think that takes care of a lot of the economic volatility. And as the affordable housing crisis hits in these parts of Oklahoma, as it does in many parts of the country, when people can't afford homes, individual single family homes to rent, they start moving down and they may end up in a RV park that's long term like this. So economic volatility may actually benefit us. Those first three are kind of exogenous factors looking in at us. We have to deal with all of them. The last one, the fourth one, is all about us. If we run a good park, asset depreciation and image don't become an issue. If you've ever seen a long-term RV park, many times they're not the prettiest things. And that's why we want to get into this asset class, make these parks beautiful. The one that we're buying is already beautiful, and the other one is it's a gem that's just hidden. It just needs to be brushed off at the edges and cleaned up a little bit. So by setting strong park rules and enforcing them, be willing to let some guests go to leave, that then we'd be able to get the kind of look and feel and guest experience in there that once the right people coming in, and that's a part that we can control, that the parks become pride of the investors and pride of the city. So as an investor, if you do a targeted investment of 100,000, as you go through the P&L, you see the 2.65x then becomes 265,000 at the end. Kind of break that down, the cash flow. Again, remember there's a 7% preferred return. So year one and year two on the pro forma show that there's an excess of the 7%. Not a lot, but that's because of the expansion. But then in years three, four, and five, the cash on cash accelerates, delivering the 11.1% overall average for the 5-year plan. And then on exit, there's a bump at the end. When we look at this right now, we're buying at about a 10.5 cap. And important to always ask, well, what's the exit cap that you are assuming in your plan? We put it right there for you. It's a 9% cap rate to make sure that you can see that there's no monkey games with exit cap rates. For every 1% cap rate benefit, so if that moved to 8, then that would be about a $700,000 or $800,000 benefit to the investors. We think 9% is conservative. We've talked to a number of different brokers. If these parks in combination grow to the nearly 700,000 NOI that we're projecting, they say 9% is not a problem in their minds, and that 8% would be a possibility. So the returns you see here reflect what we believe is a good approach to it. Again, just to give you an idea of the conservatism that we've brought to this, uh, none of these ice, propane, additional storage units could be brought on. The single largest expense item for us is electricity. And being able potentially to bring solar on. We've talked to one of our advisors, the RV park experts who's done this, brought solar into their parks, and they have offset the charges and started making offset their charges because the park pays the electricity for the residents. It's included in the rent. Well, they've been able to start making profit out of it. Have no idea whether that's possible in Oklahoma for us or not. Adding billboards in there, further expansions. This is a picture of the RV pad covers I was mentioning. We could do additional ones of those. Cost segregation study. Now with the new bill that's gone through, cost segregation studies have gone back. Accelerate depreciation has gone back to 100%, and it's fixed. So we'll be looking hard at that. Initial estimates say, and this is not anything to quote, this is just a high level estimate. It's not actually the study, but that's how these firms work. They give you the estimate and then they go back and do the actual study. So we'll be contracting to get it done. But $100,000 investment in this project would deliver about $140,000 accelerated depreciation in year one. So it's a massive impact. So anyone who's a real estate professional will understand the impact it can have. Those are the specifics around the park. Now, if we kind of zoom out for a minute, you may have the best park, but if you're in a terrible neighborhood, meaning RV parks as an investment are terrible, you don't want to be the best buggy whip when the Model A came out, when Henry Ford brought the Model A out. So let's understand a little bit about what's going in RV parks, what's going on in RV parks. Um, Big thing to get from this is for a number of years, the parks were growing. RV parks generally were growing slightly. But then in this year, 2013, 2012, 2013, it just started a climb that has not stopped. COVID impacted, but right after COVID, it picked up higher than where it was. Um, the biggest thing for us in this is one, there's growth, which is important. Two, there is significant scale that most people are not aware of. It's an $11 billion industry. And number three, and this is what's most interesting, 85% of the parks are independently owned. All the way back to that first picture that I showed of the park in Idaho, there's just individuals out there that own these parks and they don't have, they've done a good job building them. They've taken huge risk to build them, but now it's time to be able to step that up, expand them, professionalize them, and bring the kind of capabilities to the parks that we think would deliver tremendous returns. And it's a very independent owned industry, which presents great opportunities. Quick high level from long-term parks, which is what we're looking at, to the transient parks. That's the term in the industry. This park we looked at on the right is in Oklahoma as well. There are, as you can imagine, the complexity, cost structure, and operational risk on these are much higher because you have a lot of moving parts. This park we looked at had a river rafting company, a river rafting option. People in the park went to, others outside, had a general store, had a bar, had a restaurant, had nightly shows on the weekends, has all kind of moving parts. It had 100 employees, more than 100 employees over the summer. So you can imagine those kind of parks, complexity, cost structure, operational risk is very high. Whereas ours, there's one employee, park manager, that can cover both parks. Complexity is low. Cost structure, we estimate about 35% cost structure on the P&L. That may drop over time as we get some synergies. We've not built that in. We believe it'll drop. We've not built that into the pro forma. And then the operational risk is much lower because there's just fewer moving parts. Now, as you think about RV park investments, you can see that they have very high returns. The returns are strong, strong cash flows, recession resistant. As mentioned before, the simplicity of this, it addresses affordable housing challenges, which the entire country has been feeling in different areas. Very low maintenance. When you think about this, we are renting out dirt to individuals and providing sewer service, water, and electricity. Once they get those three things hooked up, then they're done and they may be there for 6 months. So we have interaction still, but it's not the same as people coming every 2 days, every day, every 3 days, plugging things in. It doesn't work, having loads on the electrical system. So it's very simple, very low maintenance. And one of the things that's very different than multifamily, there's no evictions. They are trespassing because these are seen as vehicles. It's recreational vehicles, not a home. So you don't get a deed, you get a title. So this is just like owning a car. And if someone doesn't pay, they pay in advance. But if they don't pay, they're a day, 2 days late, and we need to make a move on things, then we just call the local sheriff or authority, depending on where they route it. And they come and they start that trespass process, and they will move the trailer out of the park. So it's not a long, drawn out court process. And again, mentioned this before, this is a mom and pop industry which presents tremendous opportunities, many parks out there. It also has limited data, limited processes, limited market knowledge. To us, that smells like opportunity. If it's hard to get to, then we think that a lot of other people would not have gone through the work to get there. And to this day, there's not almost any institutional money on the long-term side, very little institutional money on the overall RV parks. And what that means, institutional money, family offices, private equity, insurance companies, as they come into the space, the the exit cap rates will compress. They'll go lower. And as those cap rates go lower, investors like all of us will make more money. So being in there before the institutional money comes in is a good thing. And we think that it'll be coming in. We've watched one that's they say they've got an offer on the table. We know one that we're working with that board of advisors. They've got some institutional money coming into one of their deals as well. So it's starting to sniff around, but it's not very prevalent. So let's go back to the high level summary of the parks, and then we'll be able to open up to any questions. Strong market demand, already at 85, 86% occupancy, low operational risk. The IRR sitting at 24.5 is hard to come by. Average annual return of 33%, equity multiple 2.65 in the 5 years. Strong execution team, and then strong cash flow from day one. That eliminates a lot of the risk to the investor because the money's coming in. We've got the 7% preferred return in there. Think that it'll be a very strong opportunity for every investor. Quick next steps. As Trevor said at the very beginning, this is open to accredited and sophisticated investors. Target investment of 100,000. Minimum investment is certainly acceptable at 50,000. We're looking for a group of investors who are ready to jump into this investment and would hopefully have eyes with a great experience to future investments. This is not going to be the last one we're doing. We've got others that we will be looking at, nothing else in the pipeline that we're bringing out to market, but we will get this one up and running. So we want to build a class of investors who are excited by what's next in RV parks. We've got documentation online through the cash flow portal, the 2 deadlines Trevor mentioned, and we've got a little bit of we've got Amber and Sandeep on here as well, and Jenna. We can extend this deadline, sophisticated investors, through the end of the month. It's been a very strong raise so far. There are a couple slots still available, but we will be able to open that up till the end of the month because as Trevor said, it was tighter than anybody wanted, but that was just the nature of it. We've only been raising for a few weeks here. Accredited investors will have to August 15th, but anybody that wants to get in should be moving quicker, and we'll have offline conversations, answer other questions. Quarterly distributions are expected to start after the first quarter of ownership because it's cash flowing. We'll build some reserves, get the CapEx ready for the further expansions. So with that, our contact information is there for the 4 of us. And you can't do anything in Texas or Oklahoma without having a Buc-ee's visit. So there we are. And we'll open it up to questions.
Awesome. Thank you very much. That was an awesome presentation. Couple of times you froze for a few seconds, but hopefully everybody got all of the content. One couple of things I want to make sure that I remind folks, it's currently a 506B offering where sophisticated and accredited investors can invest. But it's sophisticated, it's going to close within a week. So if you are not an accredited investor, you're interested in it, speak with me, speak with other folks that are big dogs on this call, and make sure that you get the information because you don't want to miss this opportunity. Unfortunately, we only have a week there for it to happen. I also want to make sure folks understand the 7% preferred payment. Even though this one is structured that it should cover the 7%, I want to make sure you're clear that until you receive 7% on your money, the general partner does not receive any money. And so that's a very important factor, right? So investors get paid first, general partners get paid second. So it's a very important factor for you to understand when investing. And obviously the significant investment of the partners is huge in this opportunity. It's above normal, to be honest. So do
I
we
have
have
a
any
question.
questions? You should be able to unmute yourself. You can use the chat. Yes, Rural. How are you doing, sir?
Hi, hello, Martin. Um,
Hello.
you mentioned that the plan was to build 10 pads per year. Why only 10? I mean, concrete cannot be that expensive.
No, that's right. It's not. That park right now sits at 100%. Thank you for the question. Good question. The first expansion is 20 pads, then the second 10 and the second 10. We want to make sure we keep building them and filling them up. Better to have a park that always looks full because it's kind of like the restaurants. When you have a restaurant, they seat you at the tables by the front first, so it looks full, and oh, that one's busy, let's go in. We want the park to be full and people wanting to call and be on a wait list. and then figure out, okay, let's go to the next expansion. We will accelerate the expansion if it fills up quicker than our plan. So it's a 3-year plan of the expansions. It may be a year and a half if we fill up the pads, and we can keep expanding further because paying out of cash flow, we could continue to pay out of cash flow, and that just boosts returns to investors greater than what's been forecasted.
Thank you.
And it really helps to balance the supply demand. So 20, they're 85+% full. Building 20 the first year, get those leased, build 10, get them leased, build 10, get them leased. Wanda, go ahead.
Thank you. Yes. And thank you for the presentation. Excellent information. Some additional questions I have. What is you mentioned the percentage of occupancy right now. What's the percentage of occupancy per season, or does it vary much? Or has it been pretty consistent?
No, great question. It does not vary. It's not a seasonal business. So the transit where people are coming on vacations becomes seasonal. This is more related to the work. And I should have mentioned this. The type of people who are staying here, the biggest group are contract type workers who work on a contract, right? Their company has a contract, so they are traveling workers. So you've got traveling nurses that are on contracts. You've got construction workers that are going to build a pipeline. They're building different aspects of oil and gas around that area. There's a Coca-Cola plant that opened just a mile away. There's a bunch of folks who have been building that out. I think they've been staying at the park. So you get these contract workers who will go where the contracts are for their companies. They're a lot of the ones that are staying in the park. So there's no seasonality per se. It's not a fun place to go. It's where they live.
Good. You just answered my second question, and that was about the demographics of the people that stay there. Okay.
Yeah.
Another question I have is, why was this location selected? I'm curious.
As we looked around for parks, this presented such a fantastic return opportunity because what we look for are long-term parks that have room to expand. We don't want to build a business model based on raising the rate, right? The rental rate, because these are already priced. Most of the parks we find are priced at the market in terms of a per month rental rate. But if you can find one that has expansion, these parks combined have 29 acres. We estimate about 12 of those acres have been built. The 3 lakes are a couple other acres in there. So we estimate we've got about 12 acres left to build on. And our plan would take about 5 acres of that. So we can both build these out and continue building, or leave something on the bone for the next buyer, right? On down the line.
Okay. Does the park have any amenities? I mean, and I know you don't have like all the entertainment type stuff, but for example, does it have internet connectivity?
Yes. Sorry, absolutely. And those things are almost like standard now. You forget that, but that is an amenity. One that's really interesting that they have, I mean, both of them have lakes on them, which are beautiful, right? And it's hot Oklahoma. So they provide some respite, some sense of peace and calm. But they also have a food truck court. The city of Ada has a food truck court, which is right next to the one park. And it's a beautiful facility. There's 3 or 4 trucks that pull up. They've got a drink bar there that people can buy their drinks from. There's picnic tables out there covered.
Oops. Froze again.
No, I think he went out for a drink.
He just got excited. Okay. I know he'll be back in a minute. I got one more
It's an
question.
amenity. It's not ours, but
Hey, we
it's
just
right
got you
there.
back. I don't know if you know we lost your volume.
Oh, no, sorry.
Yeah. Last question. I didn't hear that answer though, but I heard the first part of it. Okay. Now I've invested in other companies before. I've never done this type of investment. Is an investment stock that is dilutable with other investments, or is it capped at a certain number, or is it, how does how do your returns work with your percentage of investment, or is it just based on the cash investment?
I'm not sure I caught
Yeah, I
all
think so.
part of that question.
So again, for this particular opportunity, we're raising $2 million dollars, and depending on how much of that 2 million you put in, you will own a percentage of the actual asset. So you will own a percentage of the entire business based on how much money you put into it. And then what happens as cash flow becomes available, you get your percentage based on how much you've put in. When the property sells, you get your percentage of what the sell happens. And again, limited partners get paid first until you make 7%. The general partners aren't making everything. And then after that, the split is 70-30. The investors get 70% of all cash that's created, whether from income or sale, and the sponsors get 30%, assuming they've paid the full seven. So that answer you, Wanda?
Yes, thank you.
Awesome.
right.
Good.
Mhm.
Very good. Thank you. Great questions. EC? Oh, you're still on mute. There you are.
Yes, I'm Enrico Cortisi, and I met you, Trevor, in the meetup just recently.
Yes.
Can we just go back to the slide with the projections, the financial projections, just a little bit, please? Is it possible, Martin?
Yeah.
Yes. Yeah. Give me just a second. The pro forma.
Yes, please. The 5 years.
Yep.
Yeah. Let's go
Go ahead.
back. No, that one. Yes. Okay. So the current that is because I missed it. The current or the actual cash flow over 660 something in sales has been 330 something. Is that correct? That is the
That's correct.
current owner cash flow.
That's correct.
Why is the owner? Why does the owner want to sell if he's having like 50% margin? Quite
No, that's
okay.
absolutely. It's a great question. And these margins, by the way, are not an anomaly. His margins are quite the norm. It's very different than other asset classes. The owner that's selling to us bought these parks a year ago. He went to go for the one that's called Twin Lakes. His buy box is buying a beat up park that nobody likes, ugly, needs a lot of work, and he brings them kind of halfway to being nice and cleaned up, and then he likes to sell them. He likes to flip them from there to the next one. He doesn't want to do all the finishing work, let's call it. So he went to find this park, found it, but when he was in the process of buying that, the other park owner said, "Hey, wait a minute, if you're buying that one, why don't you buy mine? Would you be interested?" He's like, "Okay." So he put the two together. Those parks are like night and day right now in terms of the look and feel. From when he bought them, they were like night and day. So the one was beautiful. The other one has come up, but that's been his buy box to bring them up to a certain level and then turn it over. And we looked at that and said we wanted something that's a good foundation to build on. It wasn't a go, no go. Is this park going to make it? We needed to see that it's a strong operating business, but there's still work to be done to increase that value and with expansion, be able to really goose the returns.
Okay, understood. Thank you
you.
for the response.
That's a great
Absolutely.
question. Any other questions?
They're out there. And we have Sandeep and Amber as well on.
Well, last question from my
Yes.
side. What exactly do I get with the investment? I mean, do you get like a title? Do you get, I don't know,
So we're
stock?
selling a syndication and you get shares in the syndicate. We're not selling a syndication. We're creating a syndication. You're buying shares in the syndication. So you will own shares in the syndication.
Okay, in syndication, you mean like an enterprise, a company,
So that it
INC,
is definitely an
LLC,
LLC. So there's
LLC.
a private placement memorandum, there's operating agreements, there's all sorts of documents. So we're creating a security. This is very normal. When I mentioned at the beginning, I've been 34 of those, and you will own a portion of it, and you will receive your profits based on the portion that you own.
And what is the risk that you do not fill up the investors? I mean,
We don't feel that there's a risk that we won't fill up. We feel that we think the spots will fill up this week if people don't get in.
okay.
Yeah, there's
So
no risk of not filling.
there is no risk. It's actually what you're telling me is actually you are providing us this opportunity because if not, either way you will fill it up with the other guys that you have waiting. Correct?
Absolutely. That's
Okay.
right. Yeah, sometimes you go into deals and it's like, well, we need to collect all this. You may put your money in, but if they don't collect enough, then they can't do the deal. That's not the issue here. We will be able to close the 2 million.
Okay, thank you.
Hmm.
Great question, though.
Yeah.
Very good. Any other questions? Yes, you can use an IRA definitely. One thing you got to note is they take a little bit longer. So don't delay. Don't start your IRA investment on Wednesday or Thursday. Like if you're serious and you're interested, you'd like to do it. If your IRA is already set up, it's easy, but it takes us a while to get all the paperwork signed, and we need everything sealed and signed by all parties. IRAs just take a little bit longer because we have to send them to your custodian. So if you are, don't wait. You don't want to risk that the documents don't get signed in time.
There's another question from Robbie. When you call this a long-term stay park, what's the average stay? The 1819 cabins have a 6-month lease starting, and then they extend beyond that. The houses are year leases, 6 months or a year, depending on the house. But the RV park, they will stay month to month. The average stay is somewhere between 4 to 6 months, uh, is typical. So they're coming in and then they're staying there, and we'll turn that over 2 times in a year, 2 to 3 times. Oh, and then second part, if it has to be extended, what's the next interest rate? It'll be determined by the marketplace. I think it was, I'm not going to quote the rate, but it'll look at 90 days before the expiration of the 5-year term, is when they will then reset the next rate, and we have 90 days to accept that for the next 5 years, or to refinance with another one, or to have been selling the park. We can sell anywhere along. There's a minor penalty as you go if it's shorter than the 5 years, but that interest rate is unknown today.
Excellent questions. Any last questions? So there's a question, do you have any RV parks as owners?
There's no others that we have right now.
There are folks within the Massive Capital organization, and some of them, like John Kuzak's been a big dog. They've been doing them for a while, so we have a lot of experience on the greater team.
Absolutely. And we're also, I don't remember Sandeep and Amber's ownership on other assets, but Jen and I are also invested into mobile home parks, which is a very closely related asset class.
Thank you. No, thank you. This has
Thank you.
been awesome. Really appreciate everybody joining tonight. We had a great turnout. This is being recorded. Hopefully, I will get a copy of all of your emails. So from Thomas usually gets them to me. We'll make sure that you get a copy of the recording, copy of the deck. You can definitely look at the investment opportunity at any point on the portal. Again, reach out to myself, or if you are more familiar with another big dog on this call, Sandeep or Amber. But please don't delay if you're not an accredited investor. Even if you just want to get more information, don't delay. What I don't want to do is have you say next week on Tuesday, I'm in, because I'm sorry, I don't think we can get it to happen. If you're an accredited investor, you do have time, but I want to make sure that I'm clear. You can still invest while it's a 506B. You can just select that you're an accredited investor, but once it turns to a 506C, you need to go through the accreditation. So you'll either need to use our third party, you'll need to upload your financial documents, provide a bunch of documents. So if you want to hit that easy button, and you're an accredited investor, out of the 34 investments I've done, I've only done that paperwork once, and I hope never to do it again. Because it's hard work uploading everything to somebody else. So again, it's the easy button. If you're an accredited investor and you like the deal, just invest before it turns into a 506C. Well, again, we appreciate it. We're glad that you got to a place with stable internet. I was a little worried about you earlier today.
Sorry about that. Yeah.
And Sandeep, are you back in the United States? Oh,
Yeah. Yes, I am.
awesome. Welcome back. Welcome back. I know
Okay.
you've been away for a while.
Mhm.
I know you've been joining calls at 3 a.m.
Oh, we've had daily calls, and Sandeep's waking up at 3 and 4 a.m.
I
Yeah.
mean, this is an exciting project. Why wouldn't I do that?
That's right.
It is super exciting to be able to do these, and this is, I've learned a ton. You know, all this is all about learning, right? Making sure that you understand the beautiful thing about commercial real estate. There are lots of different asset classes that you can invest in, and once you start investing a lot, I do highly recommend you have some diversity in your portfolio. It's super important.
Yeah.
One last question
Yeah.
from my side. Sorry, is this an investment that has to be done by an individual, or it can be done also by a company?
So you can invest as an LLC, you can invest as an individual, whichever one you want, or you can invest through your retirement fund. You can even invest through a family trust.
Okay, thank you.
But to make sure I'm clear, you can invest as an individual. You are limited liability as an LP. So you're not adding an extra layer of protection investing through an LLC, but a lot of folks like to invest through an LLC because it opens other doors, right? You can make other expenses go through
Yes.
your LLC before you pass them
Yeah,
through yourself.
I would go that way anyway. So
Yeah.
yes, I just wanted to confirm. Thank you.
Yeah. Awesome. Very good. Well, we
Great
finished
presentation,
right
by
on.
the way.
Excuse me,
Great.
sir.
Thank you.
I missed what he said. Sorry.
Great presentation.
Oh, thank you. Yes. Yeah, he's done a great job.
I didn't want to say it was a great presentation because that sounds really bad.
I'll take it's a perfect presentation because I helped him. I'm only kidding.
Exactly. He did. He's giving
Yeah,
good.
I like to, I
presentation
help
as
everybody.
well.
I like to.
Absolutely.
It's good to see everybody. Oh, nice to see you, Audrey. I didn't notice you were there.
Thanks, Trevor. I always love to hear about this because it's so interesting to me.
Audrey and John have been huge fans. They're jumping up and down.
Yeah. Yeah, they're awesome folks. Let me just see if I missed anything. Just a few thankfuls. Good to see you back from your cruise, Lisa. I hope you had a great time. She
It
didn't
was
invite me to come
fantastic.
on her cruise. You know, I offered to go in the suitcase, but
Oh yeah, no, it was wonderful. Thank you.
yeah. All right. Well, everybody enjoy the rest of your evening. Again, reach out to myself, reach out to any of the deal sponsors, other big dogs. Again, if you're interested, don't delay. This one's going to fill and it's going to switch to a C next week.
Thank you.
Awesome. Thanks,
Thank you all.
everybody. And you all have a great evening.
You
Okay,
too.
thank you. Bye bye.
Go.